My name is Trent Zimmermann, and this is your 20-minute Annuity Tuesdays brought to you by BGA Insurance. BGA Insurance is a uh, life insurance, annuities, long-term care, and disability wholesaler working with independently licensed insurance agents and financial advisors. I run the annuity department here, and this is your 20-minute Annuity Tuesdays. Now, the goal with this, as I've said before, is to uh, walk you through what I'm seeing in the industry right now, give you some best practices that we're seeing with our top performing agents, and sales ideas, niches, and product updates we get from our carriers. Now, I'm not going to say this one is a best practice. This is not going to be a strategy that I am advocating you use on a regular basis. And there's going to be a lot of caveats and warnings on this. The reason I wanted to bring this up, though, is because in the last month, we've had three situations that have hit like this. And, they say this in Hollywood when a celebrity dies, everything comes in threes. So I think we're out of the woods on our side of experiencing this. There might be scenarios in your book of business that are similar to this. Um, but it's been scenarios where individuals have been running out of money. So let's go through a case study that is a real life scenario that we just worked through. We have Stu Smith, obviously names changed for privacy. She's been a widow for 13 years. She's in good health. She has a history of family longevity with individuals living well past 95. But she's got $34,000 left in her brokerage account, $16,000 in her money market account, 21,000 in a bank account left. She owns her home outright. It's now worth about $1.5 million. That's without any appraisal. It could be higher. And she has a very low property tax basis. She bought this home with her husband in their 20s. Um, and she has about $72,000 in income between Social Security and an annuity her and her husband set up. But that annuity at the time was marketed to be a decreasing annuity. So when her husband passed, the amount of income she got out of it had dropped. Uh, Now, by her own calculation, she needs 5,000 more dollars. She couldn't keep up with inflation over the past few years. So her home is her biggest asset. Now, the worries with her, and I'm sure you all are well aware of this, is downsizing would drastically increase her property tax rate because she's living on a house with a very small basis, and the tax is based off that original price and not off of her current value. And so moving, she could buy a $500,000 condo somewhere, and it would be probably far away from where she is now. But she would then be paying a property tax based off that 500,000 instead of her original less than 100,000. And selling to rent, on the other hand, would increase your monthly costs. And the rent isn't guaranteed. So that's going to be going up on an annual basis. Now, both of these, because of her low basis, would also incur capital gains tax. And a large alteration in lifestyle and community connection, likely take her away from her current area that she's in now. And on top of that, selling felt like an overreaction to her. So on the emotional side, uh, it felt like an overreaction for $5,000 a year, and she didn't wish to entertain the idea. So these obstacles aren't things that you can't overcome, but they are. There was a mental barrier there, and so I got the phone call actually because she was looking to say, is there any money left in my annuity that I could pull out as free withdrawal just to get through this year? Because she's looking at maybe 12 years left in her assets to carry her in those $5,000, but that's not accounting for inflation. That's not accounting for the water heater going out or needing to replace her roof or any large expense. So uh, she was put forward with this strategy on the left. somebody had approached her and said, we can give you $350,000 in a loan. It'd be a lien on your house. Uncapped interest accrual can become upside down on equity. Does not share in the upside or downside risk. You know this as your classic reverse mortgage. But there is a guy who is friends with us, just in full disclosure, who had worked in a similar insurance vein, who had created a fractional share home equity line. And that would have offered her $331,000 in payment. It was a non-debt instrument, does not place a lien on her home. It was a purchase of a fractional share. Now there is a cost recapture, so she's not getting that $750,000 in buying 49%. She's getting much less than 331. And so that fractional share increases over time with the cost recapture until 49% ownership of the house is attained. Now, this shares in the upside, but it also shares in the downside. If her house decreases in value, if we have another 2008, and her house is now just worth $1 million, she can't be upside down. But if her house increases to $2 million, that fractional share is now worth, $1 million in this case, with the 49% ownership. So we're looking at traditional reverse mortgage versus Chaise plan. With that, she was able to create $401,000 in liquid cash by selling a fractional share in her house. And no, I did not create 401k to be clever. That's just how the math worked out. And the plan with this, because annuity companies will accept 70% in liquid net worth in annuities. We decided to go a little bit lower than that and do 60% because you didn't need all that money, and increase your discretionary spending budget up from $71,000 to $161,000. And that 60%, $240,000 in an immediate FIA, so that there was some cash value there. She needed to pull out some excess. Could create $20,000 in annual income. Now, we've talked about MIGA ladders, we've talked about income ladders. I'm a proponent of that. And so we put forward a strategy to create just what she had asked for, just $5,000. So she would allocate about $60,000 into that Symmetra annuity there for year one, $5,000. Now we're worried for her about inflation and that continuing to eat away at her discretionary budget. So we put aside another $55,000 that could create another $5,000 in year two. If she doesn't need it, great, continue to let it roll up. And then we took the remainder of this 240. In this case, we were just looking at round numbers, $12,000 at the end for illustrations. But we could take the remainder of that 240 and put it into a large lump sum. In this case, we chose Mass Mutual, but a great choice would be something that has an income doubler. In this case, we were looking at it being able to be deployed in year three. The income double product didn't look good in year three. It looked good in year six onward. But we were able to say we can provide you $12,000 if you need it in year three. And so now instead of that $20,000, we're looking at $22,000 created over 3 years. But the benefit of this is if she doesn't need it. If she's right and she only needs $5,000 for the next 3 to 5 years, she can continue to let that $5,000 roll up and that $12,000 roll up and deploy them when she needs. And the benefit of that for her as well is now she's conserving that home equity in value to continue growing, to leave as a death benefit if she never needs them for heirs. Whereas if she took that $20,000 starting year one, that death benefit would be depleted somewhere between year 10 and 13. If she lived beyond age 85, she would have no more death benefit. She would lost 49% of her home equity and received uh, about $260,000 for 330. And that's the rub with this. Uh, but let's go first with why it worked and then all the caveats that we need to work through. So reverse mortgage caused fear for her with 2008. She didn't need the maximum amount of upfront payment. She was able to supplement her income immediately and get that $5,000 she was looking for. And we planned for longevity. We created a plan to have two more buckets of annuities that could be triggered if she continued to run out of income, so that we could preserve that discretionary spending and let that continue to grow in the market as well. We preserved her capital, so because we were offsetting those two others in the ladder, if she were to pass away, if she were to never need them, those were able to continue to grow and be able to provide that value to her heirs. We replenish her reserves, and she's able to stay in her home. And while staying in her home, she's not owing any mortgage insurance payments that she would for a reverse mortgage. She's never going to be upside down. She's always going to own 51%, and she can sell her home tomorrow. It's not a good idea because of how the cost recapture works, that she's not getting the best growth out of that 330, but it's still available to her. But let's say she deploys the $5,000, she deploys the $12,000, and she's still upside down in her finances. And 15 years from now, she can say, I'm going to sell my home. I'm going to capture back my 51% in value, and I can use it to supplement my retirement there. So it still remains as a backstop, whereas in a reverse mortgage, it wouldn't. Now, there's a lot of rubs with this. This strategy is sold as a strategic reallocation of assets, that there are trillions of dollars captured in home equity that could be used elsewhere because the historical return of home equity has been between 4 and 6%, and the stock market has been 10 to 11% historically. And so you could reinvest that money there um, in order to get better returns and perform better. And if you use a product like an annuity or life insurance where there's an internal IRR greater of that 10%, the sky's the limit. I have an issue with that because there's essentially 13 to 15% cost recapture until you meet that 49%. So it incentivizes a long-term play, which people aren't thinking about when they're talking about selling shares in their home equity. And the high cost targets high value homes. You're not getting a lot out of a low value home if your home is worth $1 million or less. So with the payout and the payout because of this cost recapture, that cost recapture of the 13% builds in some of the gain in the house that year plus cost recapture. That's why it's a capped. It could be less than that 13%. But it's capped if the gain on the house the next year is 9% and they want to recapture some of their costs associated with this upfront payment, they can only recapture up to 4%. So that means the payout on these, even though you're selling 49% of your home equity, it can be as low as 22% on $1 million home. It can be on a 1.5 that looked a little bit more like 30%. And so it scales up. But if you have that high value of a home, you're most likely, unless you've owned this home for a long time, you're probably not in the position of needing to supplement your retirement. Uh, you might be, this situation, but it's not typically that person. And then finally, no matter how we did the math, we're looking at about 22 years in order to make your money back. So let me put that in a different way. Let's say um, you sold 49% of your home. and you put that into annuity. And you put 60% of that into an annuity. So the hope is that you are going to recapture 60% of that home equity. Let's not pay attention to the payment that they give you because you're looking at what you're receiving in income. So our goal is not recapturing 60% of that 330. Our goal is to recapture 60% of that 750. And no matter how we broke this up with different home values, different ages, the crossover point remained between 20 years and 25 years. Even if we deferred to get a bigger payment out, maybe it would be 18 years to receive that money back, but now you're deferring for 4, and that gets you back to 22. That's a long time to recapture that cost. Now, if you're looking at, I have 2 more years left in my retirement, uh, of having money, that doesn't matter to you. You need to be able to survive. Um, and in this case, you're never going to be upside down. So you have backstops here, but you are spending a lot of money to recapture income that won't be seen for about 22 years. So that there are some advisors that we work with that are using this plan on the front end that have 65-year-olds that did not save enough and are saying uh, we're going to fend this off on the front end. We're going to sell 49%. We're going to buy an annuity. We're going to let that roll up for a few more years until they can maximize Social Security at 67, and we'll deploy this at 68. And they know that they're probably going to live past 88, based off their life expectancy, and they're able to preserve this retirement savings bucket that they've created, and now they can get more aggressive with it, and it can earn more, and they're getting that alpha elsewhere, and that's fine. I'm fine with that plan on a general basis, but that takes a lot of foresight of somebody not being able to make it through their retirement. Uh, and so I don't agree with this as a strategic reallocation of funds. However, I do see this as a backstop that has some more protections than the traditional reverse mortgage has. And again, this is not me out here saying you got to be talking to all your clients about selling home equity. Far from it. Far from it. First line of defense should be their retirement savings and buying income and investing the rest. Stop there. If they're looking at dire straits where they are going to run out of money in their retirement in the near future, and they are not going to be able to live off of the income that they're able to generate, this can be an option, and this can be an option where they can no longer be they won't be upside down, and there's still a backstop of 51% left in home equity if they need to deploy a second round. So again, this is called Chiefs. We've talked about it before. In full disclosure, they are friends of us. You can call me here and talk to me about this. And like I said, this is not an advocation of this being in the first strategy, but it is an option. So now I see that there are some chats in here. Let's see if there's anything. Is he a friend of yours or a friend of ours? He's a friend of ours at BGA. Yes, the client is responsible for home taxes and HOA fees after the sale. They still are the majority owner of the house, and they are the one on the title. Good question there. All right, I'm going to launch the topics for next week, and I'm going to walk you through them. That's 20 minutes. If you need to leave now, I know I ran close, but we have pairing annuities with buffered assets as a way to build a retirement plan that you're not pulling out in negative years. AUM protection plan. This is designed to protect assets under money by buying income and also offsetting RMDs, required minimum distribution. Buy income and invest the rest is just going to be a one-on-one on that concept of buying income and how that affects your portfolio. And cap and par rates 101, how they build those cap and par rates on the indexes, why they're at where they're at, how long they are projected to stay at that level, and what to do once you're out of surrender period. So that's the topics we have suggested for next week. Go ahead and vote, and I will call the poll when I see people stop participating. All right, I'll give it 15 more seconds since we have a three-way tie. All right, it looks like we're doing cap and pars 101. Pairing annuities with buffered assets was doing well for a while there. Actually, let me share the results with you. And buy income invest the rest search in the end. So, what we'll do is we'll do cap and pars 101, and then the following week I'll do pairing annuities with buffered assets, since that one's going to take a little bit of extra work on my end. Let me hop out of this. Let's see who's on there. Is there anyone else who has questions, comments, concerns? They want to tell me who they like for the Kentucky Derby coming up. I'm looking to lose $20 on your bet.
I can have my family go to Keeneland and get you the odds if you want.
And I've got Kelsey for that now. All right. And with that, that's your 20 minutes. Thank you all for joining. And I will see you next Tuesday.